Welcome ladies and gentlemen to this video. During the past few months, the market sentiment has slowly shifted towards the bearish side. Some of the best hedge fund managers, experts in the field of finance, and billionaires have been predicting economic slowdown. One of the most prominent out of all has been Chamath Palihapitiya, who has pointed out the consequences of the Fed's actions. We all know that Fed printed money way out of proportion, and as a result of that, the stock market soared to all-time highs. The euphoric market has been based on unprecedented speculation and lower interest rates. Now the consequences of these policies are felt across the economy. If the prices kept on increasing at the same rate, it will lead to a catastrophe of unimaginable proportions. This is what worried so many renowned investors and economists. Chamath thinks that it is not the inflation which investors should worry about, and he pointed out a totally different indicator which, according to him, one should keep an eye on as the events unfold in these uncertain times. The US economy is crumbling, and as per Chamath, Fed might overreact to the ongoing problem and raise interest rates aggressively. That will most likely cause the US economy to go into recession. Just imagine, the government pumped $10 trillion into the economy. A significant portion of that money was injected into the stock market and crypto markets to form two enormous bubbles. But when the interest rates rise, it will accelerate the collapse of the stock and crypto market. In that case, the net money outflow will potentially become negative. Already since the last 2 months, the stock market and the crypto market have started to correct, and now the prices of stock and cryptocurrencies might tank further. According to David Sachs, who is a famous venture capitalist, the recession is imminent. Chamath shares the same viewpoint as him.
Jeremy Grantham is sort of a
old school
kind of bearish type market commentator. He had this expression that it's more one of these stop clock right twice a day things.
Jeremy Grantham has never found a market he didn't name.
Yeah, exactly. But a stop clock can be right twice a day. And the line he had today is that we're seeing the popping of a super bubble. And we've been talking about
super bubble.
Yeah,
Evocative.
Exactly. Basically,
but that's not true. But I mean, it's good.
Yes,
well,
it's evocative.
Well, the sense in which it might be true
Super
is
bubble.
that, I mean, we've talked about this last few months, is that you had the Fed and the federal government pump a 10 trillion of liquidity into the market over the past 2 years because of COVID. Now they're starting to pull that back. And there was, I think, a general asset inflation across asset classes. Certain types of assets clearly got more inflated than others. We've seen a huge correction in growth stocks. We've seen a huge correction in crypto. Basically, anything long dated, as the fear of interest rates increasing has gone up, they've massively corrected. But so the concern is that, with the losses we're seeing, and I mean, every day I keep seeing more red, that this could turn into a recession. Popping of bubbles is usually followed by a recession. So I think, the fortunes of the economy could turn really quickly here. And
that is the marginal risk. The marginal risk is actually for a recession. We talked about this before. By the way, just to your point, you're right that we pumped in $10 trillion, but over the last 3 weeks, and really over the last 2.5 months, we have actually eviscerated $10 trillion of value as well. So if you want to measure it, we put 10 trillion of excess capital in, but we've now destroyed $10 trillion of equity.
Destroyed it by lowering the prices or repricing stuff. Yeah, we've repriced
equity,
everything.
Crypto. I mean, crypto in the last couple of days has just been shellacked.
Yeah.
Growth stocks have been shellacked. Biotech stocks have been just absolutely smoked.
Now, looking at the global picture, as the US is planning to increase interest rates, China is doing exactly the opposite and is planning to lower the interest rates. We are in a connected world, and it is highly likely that if Fed increases interest rates, it will crash the Chinese economy. China is the second largest economy and accounts for 15% of the world's GDP. And a catastrophic collapse of Chinese economy will definitely be a disaster for the American economy and many other economies in the West too. We all know that China's real estate sector is going through deleveraging, which means that companies lower their debt by selling their assets. And this has been observed in case of not just Evergrande, but also a number of other developers. We have a similar situation as in 2018. Before we go ahead and look at Chamath's viewpoint, if you have enjoyed the video so far, please hit the like button and subscribe to the channel for more content like this. This will mean world to me. This is what an anonymous Chinese policy insider told Reuters, "We definitely need to loosen policies as the downward pressure on the economy is relatively big." A chief economist from Zijin Investment, Lian Peng, expects one or two more required rate of return or RRR cuts this year. This might seem enormous, but some economists and experts expect even more chaos. One prominent figure is Zhu Honchai, who is the deputy director of Chinese Economic Policy Commission. Zhu Honchai is convinced that RRR will be cut by at least 3 times in 2022. These cuts are inevitable due to the US Federal Reserve. We know that the US dollar increases in value as the interest rates are increased, and as a consequence, more dollars will be held by people. As Chinese government lowers interest rates, it will cause the value of Chinese yuan to go into a nosedive. These events will put a lot of pressure on the People's Bank of China.
The risk, in my opinion, is not of runaway inflation anymore. And the reason was what happened this weekend was incredibly important. And we have seen this happen just a few years ago. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with this issue of whether we should raise rates and by how much, because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating, right? You need to incentivize businesses to spend by lowering.
By turned over, you mean it's slowed down. People are not building, companies not doing new projects. So you want to give them an incentive or maybe some catalyst to start some new company or start some new project because all their real estate projects have wound down.
In 2018, here's exactly what happened. The setup was the Fed, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over. And we realized that their economy was not nearly as strong as we thought it would be. And so our reaction was disproportionate to what the actual data on the ground said. We entered a recession in 2019. That's when you guys probably saw Trump going crazy, blaming Powell. I mean, most of us ignored it because, we were all dealing with, Trump derangement syndrome. But the underlying thing of what he was saying was, hey, hold on a second. You just caused a recession in America by raising too quickly. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates on Wednesday, I think, of this coming week. What is he supposed to do?
Just a week after Chamath made his prediction for an upcoming recession, Chamath turned even more bearish. And this is because China is not alone in the boat. Germany is also showing signs of slowing down. Germany has cut its growth forecast to 3.6%, down from 4.1% before. According to the German economic minister, Robert Habeck, Germany's economic problems are a consequence of coping with adverse effects of pandemic.
China cut rates. This past weekend, actually, Germany decreased their GDP forecast. And so you're starting to see two huge countries already say, hey, wait a minute, we need to be, more realistic about what long-term growth looks like here. It's inconceivable in my mind that those countries are slowing down and we won't. And so I think what happens in these other huge GDP drivers of world GDP will affect us. And so, Sachs and I have said this before, but the marginal risk will be that we overcorrect and actually create a recession that doesn't need to be one.
In the recent FOMC, or the Federal Reserve Open Market Committee meeting that Chamath mentioned, the Fed Chair Jerome Powell focused mainly on raising interest rates and cutting down the purchase of bonds, and that supports Chamath's viewpoint. The markets are forward-looking, and this means that since investors know that the interest rate increases are going to come, therefore this fact has already been factored in the prices of stocks and cryptocurrencies. So when the interest rates do increase, we won't see any major effects on the markets since the interest rate increase has already been priced in, and it might potentially be a better idea to start accumulating the stocks and cryptocurrencies for cheap via dollar cost averaging.
The FOMC meeting happened this week, and Powell basically said, look, we're going to start tightening in March. I think the way that he said it, all of these words tend to be so scrutinized and overanalyzed, but instead of figuring out what people thought, I think their actions post the FOMC are important, which is that, we effectively now started to price in about 5 rate hikes this year. So probably 5 25-point rate hikes. Effectively, that's what the yield curve tells us. If you take a big step back, I just want to remind people, like, it's really hard to live through volatility, right? And we're in a phase of it now. But typically these big drawdowns, so like, when stocks go down, it actually precedes, so it comes before the actual starting of a rate hike cycle. And so if you go back to from 1950 onwards today, every time the government has started to raise rates or the Federal Reserve has started to raise rates, the stock markets have actually rallied. Now, why is that? It's typically that they see through the end of the rate hike cycle and they start to price the business as if these rate hikes are done and to rebase things. And on average, I think the stock markets go up between 7 and 8%. So call it 7.5%, 8.5%. And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get?
Peloton and Zoom were kind of mid-tech. I don't know what we call those, but I would call them like mid-tech. They're obviously not big tech, but they're not small either. Mid-tech gets their asses kicked 50 to 80%, big tech 15%. But if big tech goes down 30%, then we start really seeing a bottom. And we consider Netflix part of that.
You'll ever see that, because I think big tech, you have to remember, is basically the index. And in the last 10 or 20 years, you've never seen drawdowns more than 15 to 25%. You've never seen it. And when you've ever had a 15 to 25% drawdown, meaning the market goes off 15 or 25%, you have to remember the thing that we have also done over the last 20 years is created so much money on the sidelines, always looking for a cheap buying opportunity. And so the minute that these things, so even, in March of 2020, remember when we started to do this pod and it literally looked like the world was ending?
Yeah.
The bottom existed for a week.
Yep.
And then within a week, the entire 25% loss in the stock market was wiped out and we were back to normal. The risk is to a recession, because if we overcorrect,
yes,
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now we have to decide, because if we overcorrect, we're going to plunge the United States economy into a recession.
No, one thing is for sure, raising interest rates is a must to suppress inflation. Even though both Jerome Powell and Chamath believe that inflation would be transitory, I think that its effect will linger on for much, much longer. The global economy is weak, as we have already seen in the case of major economies like China, USA, and Germany. And the slowing down of the biggest economies in the world could definitely put brakes on the inflation and slow it down. Overall, I would say that we are going through very challenging economic times. The biggest global economies are showing the signs of slow growth, and the bubbles in various markets seem to be quite evident. Let me know in the comments below. Do you agree with Chamath? Meaning, do you think that we should dollar cost average and start accumulating stocks and cryptocurrencies? And do you think that the interest rate increase is already priced into the prices of stocks that have plummeted significantly since the start of 2022, especially the growth stocks? If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it, and it means world to me. You are awesome, and as always, I will see you guys in the next video.